Pakistan's dependence on foreign financial support has only been deepening, with Saudi Arabia adding another $3 billion to Pakistan's reserves. The fresh support comes as Islamabad continues to rely on external assistance in order to shore up its finances and bolster its foreign exchange reserves. Well, that takes Saudi Arabia's cash deposits with Pakistan's central bank to $8 billion. For Islamabad, this provides critical support for foreign exchange liquidity and external financing. But there is an important distinction here. This is not a structural solution to Pakistan's external financing problem. It is another round of support that helps the country manage its immediate financing pressures. And now Pakistan is looking towards Washington. Finance Minister Muhammad Aurangzeb has confirmed that Islamabad has formally sought a $10 billion exchange stabilization support facility from the United States. The government says that this is not supposed to be a conventional loan or credit line. Instead, Islamabad wants it to act as a signal of confidence in Pakistan's currency and foreign exchange stability. The idea here is simple. A stronger external backdrop could improve investor confidence and thereby help Pakistan return to international capital markets for longer-term borrowing. The government says it wants to move away from repeated bilateral rollovers and towards 5 to 7 and even 10-year market financing. But there is an important question here, and that is, will Washington agree to the financing? The risk for Pakistan is that if the US facility does not materialize, the country will still have to meet its external financing obligations. And that would leave Islamabad with fewer options at hand. It could have to seek more support from the existing bilateral partners. It could have to negotiate further debt rollovers, or it could potentially have to return more aggressively to the international capital markets. The government says that it wants to move towards a B+ rating and longer maturity debt, but that very transition requires something more than foreign currency inflows. It requires stronger fiscal management, higher exports, greater investment, and a reduction in the country's dependence on repeated external support system. That brings the story back to the central problem, and that is Saudi money can buy Pakistan time for now. Chinese rollovers can buy Pakistan time, and a potential US facility could buy even more time. But none of these above options by themselves change the underlying economic model in Pakistan. The country's challenge is no longer just finding the next $1 billion. It is building an economy that does not keep asking for the next $1 billion. And until that happens, every fresh deposit, rollover or bailout risks becoming another lifeline than a way out of the financial debt and the crisis.